Firstly, an agent is considered a person or an organisation which has been appointed to act on behalf of another party, the principal. Agency is a common method in not only today's accounting world, but it is also present in many other negotiations where mediation, as well as an outcome, is required. An agent may be appointed where there's also a conflict of interest. The terms of the principal-agent relationship are generally outlined in a contract, although by law, agency can also be express or implied. Another example of agency is an investor buying a number of shares, thus becoming the principal and giving them to a fund manager or a stockbroker to manage, who then becomes the agent. Problems with agency can occur where the agent has acted without authority, and cases of this nature can often end up in court. A prime example of this is in the case of Green and Anor versus Meltzer and Anor, whereby the chief executive of one company entered a contract without the authority of its board, and the courts decided whether or not this contract was void or not due to the lack of authority. When employing an agent, the principal also runs the risk of the agent failing to act in the best interests of the principal, as well as the investment. This is a common occurrence, as it has been seen in the past that fund managers are known to have a different agenda to that of the principal. And this agenda may include activities such as the manipulation of stock prices as well as insider trading. This was the case in the Enron scandal, whereby the price of the shares plummeted from $90 to $1 in a 15-month period, with the shareholders then filing a $40 billion lawsuit against the company. It's impossible to guarantee that an agent will act in the best interest of your portfolio, but through monitoring and regulating their activity, the risk of this is largely decreased. As stated above, a very common example of an agency relationship is of that between shareholders and fund managers. In order for a fund manager to have a stable income and to be able to cover their expenses, it is necessary that they charge a shareholder a base rate and possibly even a commission depending on the performance of their portfolio. The fund manager's expenses may include things such as registration, wages, superannuation and travel, all of which need to be included in the cost of the job in order for money to be made. They are only a few examples of the costs associated with agency, and these costs will vary from company to company, and as will a list of expenses that need to be covered. Generally, when dealing with agents and fund managers and the pay schemes involved, there is a base wage as well as a provision for performance-based incentives. This allows the principal to negotiate reachable as well as profitable goals for the agent to strive for, and if these are met, they will be rewarded accordingly. Using a performance-based incentive scheme allows the principal to dictate their profit margin, ensuring that if the agent does not act in the best interests of the principal, that he will not be operating at a loss due to this. Alternatively, incentives can also motivate the agent to work harder and in turn increase their own income. When using an incentive-based scheme, it is important not to focus all of the attention on the end result. Attention needs to be paid to the processes that took place, as a result-based scheme can often lead to unprofessional and unethical business behaviours. Some of the more successful and stable incentive schemes take a more rounded approach, focusing on behaviours, processes and professionalism as well as the final outcome. Managers use a wide range of short and long-term incentives to keep an agent motivated, as well as providing something for them to work towards. The most common example of a short-term incentive is cash, a simple financial reward for meeting a monthly, quarterly or annual goal of the company. Other examples of short-term incentives include time off, as well as capital upgrades such as a new work car, new office or new work phone. These are all rewards and bonuses offered in turn for performing above expectations. A common example of a long-term incentives is ownership in a company. If an agent is provided with shares and ownership in a company, they will continue to act in its best interests, as it's also in their own best financial interests. Other examples of long-term incentives include holidays and time off, cash bonuses, as well as management positions or agency costs. Most of the incentives offered to agents, both short and long term, either reduces the agency cost or avoids an outlay of cash to the agent. Work cars, phones, new offices and promotions may all cause an initial outlay of cash, but none of this is leaving the entity as it now has ownership of these assets. It is common practice for employees today to be rewarded with work phones and cars, and this can often work in favour of both the manager and the employee, as a wage increase would place the employee in a higher tax bracket, and neither the employee or the employer would benefit from this. Thank you.